Hi there. If you're thinking about buying your first home, you're probably hearing a lot about FHA and conventional loans. But how do you know which one is really better, not just today, but in the long run? I'm Mike Price, and I've helped hundreds of buyers save thousands through smart mortgage planning, and something I created called the Hybrid Agent Program, which we'll talk more about in a second. But just know this: no matter which loan you choose, FHA or conventional, my program is designed to make your payment even lower. Let's talk about FHA first. FHA stands for the Federal Housing Administration. It's one of the most flexible loans available, and it's not just for first-time buyers. With FHA, you can put down as little as 3.5%, qualify with a credit score as low as 580, and get approved even with a higher debt-to-income ratio, sometimes up to 57%. But here's what really matters right now. FHA interest rates are currently lower than conventional. As of today, for a $400,000 home and a 740 credit score, an FHA rate might be around 6.25%, while a conventional loan could be closer to 7%. That's a big difference, and it translates to about $83 less per month on the FHA loan, even with the same borrower profile. But there's more to the story. Let's talk about mortgage insurance. FHA loans have MIP, mortgage insurance premium, and conventional loans have PMI, private mortgage insurance. Here's the difference. PMI on conventional loans can fall off once you reach 20% equity, and it automatically drops off at 78% loan to value. FHA MIP stays on for the life of the loan unless you put 10% down upfront, and even then it sticks around for 11 years. That means if you go FHA and don't refinance, you're going to pay that mortgage insurance every month for as long as you have the loan. On a conventional loan, once PMI falls off, that monthly savings goes straight toward your principal and interest, helping you build equity faster. So the question is, does conventional eventually catch up to FHA? The answer is maybe, if you're in the home long enough and if your credit qualifies you for a low PMI rate. But for many people, especially if you plan to sell, refinance, or upgrade in 5 to 7 years, FHA still wins. But now let's talk about the Hybrid Agent Program, because this changes the game no matter what loan type you go with. Here's how it works. I'm not just your realtor, I'm also your mortgage expert. And because I do both, I combine my real estate commission to buy down your interest rate, helping you get a dramatically lower monthly payment. I also negotiate seller credits and structure your deal in a way most agents or lenders simply can't. The result: my clients often save $400 or more per month compared to others using traditional agents and lenders. Many come to the closing table with zero out-of-pocket costs, and your total savings over time can add up to $100,000 or more. That's on top of the already competitive FHA or conventional rates we just talked about. So whether you're leaning toward FHA because of the lower rate, or you're thinking conventional for the long-term PMI savings, the Hybrid Agent Program gives you a third option. Get the best of both worlds and pay less either way. Click the link below to learn how the program works and how much you can save. I'm Mike Price, and if your mortgage isn't coming through me, you're probably overpaying. Let's fix that.